Good morning, everybody. It is Tuesday, January 19th, 2021. The covered call with Kirk Spano, margin of safety investing over at Seeking Alpha and fundamentaltrends.com, which is my standalone service that is currently still undergoing some renovations and should be up and running soon. I just talked to the developer a few minutes ago. Everybody's names and IDs and memberships are loaded in. Now we just have to get everything tied together and activated, hopefully by the end of today, but it seems like tomorrow at the latest. So put up the chart notebook about a week ago, and we went through the charts last night in the stocks of the week call. And what we found is that there's very little out there that we want to get too involved with right now. The name of the game is still trim your stock positions into the strength and sell covered calls against most of your positions, with very few exceptions. There are very few puts out there to be sold. We're looking at 1, 2, 3, 4 companies maybe, but you take a look at Newmont, and that's susceptible to an S&P 500 correction. You could probably sell some puts down at the $60 range if you're willing to own it for a net cost of about $58.20, because you get about $1.80 for that put for February 19th. AT&T is the one that still looks extremely inviting to me. I think that if your position in AT&T is not up to 4% of your portfolio that you allocate directly to stocks, then I think selling a cash secured put in that 29.30 range is probably the way to go. Go ahead and collect some premium for setting your money aside to potentially buy more AT&T. If you can see here, February 12th, selling for about 79 cents. The traditional monthly is at 85 cents. So I think you probably do the monthly. You can bump it up to $30 if you really want it put to you. Get $1.44. But as you can see, your net cost here is 29 minus 85 cents, 28.15 versus 30 minus $1.44, 28.56. So I would sell the 29. And if it gets put to you for a net cost of 28.15, that's probably a pretty good addition, unless your cost basis is already down in that range, in which case you'd want to wait for a dip. We take a look at the chart of AT&T, all of its interesting numbers, RSI, whatnot, everything is still kind of in the middle. There's nothing technically compelling about it. So you go to the fundamentals, you take a look at the technical chart over a while, and you say, you know, it really seems to be coiling up in here with a relatively equal number of buyers and sellers. If their subscription revenue surprises to the upside here in coming weeks, I think you're probably going to see this jump quite a bit. Barrick Gold, same deal. If you need more, go ahead and sell a cash secured put. The one that the formula likes is the Barrick Gold March 19th monthly. Get 52 cents for it. 52 cents minus $21. Net cost of about $20.48. So if that is below what your cost basis is and you're looking to add to it, again, I think this is another stock that you can bring up to as high as a 4% position in your portfolio. It is tough to sell covered calls on these stocks with such high prices. Alibaba, the land of the commies, doesn't seem to me to yet know where it belongs. Came off of a bit of an almost oversold, but the money flow index is not looking too good, right? So that's still heading down, but it should be bottoming out here soon. If you flip on over to the MACD, looks like it's also bottoming out. Signal line is starting to turn. My buy price for Alibaba is closer to this edge. I had it set at 190 for a while, but I think 180 is legitimate as well. See where this fought with the resistance straight across. And this has been a pretty battleground area right in here. If you can buy closer to the bottom than the top of this area, I think you're in good shape. This chart to me looks like it has one more leg down. But even if it doesn't, I don't care, because I only want to buy commie stocks if I can get them dirt cheap. And I don't know if this is going to go to here, so I ignore it. Too much risk. If we flip over to our covered call screener, we're going to see a bazillion potential covered calls. I mean, this is a broad market, just a ton, 540 potential covered calls. So if we flip it over to just VSL stocks, still have quite a few. This is something I had been covering a long time ago. And Antero, they're selling that you should sell a covered call. Baidu, they're saying Ford. Today might be a good day to sell a Ford covered call if you have a really big position. And I'm talking, it's grown to 5 or 6% of your portfolio. I would probably trim it back to 4% and then write a covered call against half. But again, I believe that the announcement that Ford is going to make is going to be pretty dramatic, probably more impactful than the Microsoft deal with GM today on the cruise. If we take a look at Ford, you do see that it's a little bit overbought and could come back a little bit. I just don't want to risk losing any of this stock, because I believe you are going to see a much, much higher high here. I believe that Ford heads back all the way into the 30s. And sometimes you just want to let your winners run. You can nickel and dime it if you want to. You really can. You can always nickel and dime things. Try to squeeze out a little bit more. But when you're trying to hit a home run, and this is clearly a stock that's positioning for a home run, there's a lot of money that flowed into Tesla that can come flowing out as people diversify. I don't know that I would do much of anything with Ford, but theoretically, because RSI is getting towards overbought on the weekly. Oops, that's monthly, weekly, right? Overbought on the weekly. You could conceivably sell a covered call here. You have to weigh for yourself how much you're willing to have called away. Maybe half of a position, maybe a third of a position. And it depends on what your asset allocation is. If you only got 1% of your money in Ford, I would not be writing a covered call. If you have 4, 5, or 6% of your money in Ford, then maybe you write a covered call against part of the position. In which case, the $12 February gets you nothing, but the March $12 gets you 17 cents, right? So the annualized return is actually pretty good. So that's probably the one that I would look at. Lets your stock run, puts a couple bucks in your pocket. If you got 1,000 shares, you're making 170 bucks. It's okay. Yeah, 10,000 shares, a little bit more significant. But again, I think that Ford is going to run, so I'm not real aggressive here selling covered calls. Go down the list. GE, I think this is just a chance to get out of GE. If you own GE, here's your chance to sell it because it's going back in the single digits. They just have way too much debt, and the business transition that they're making is going to take a very long time and probably require that they somehow get paid for assets that nobody wants. It's kind of like Exxon. Exxon talks about divesting assets. Who's going to buy them? Same thing with GE. Who's going to buy their assets? They're dying businesses. Freeport-McMoRan, a little bit more interesting if you still own some of that. It's grown to a big position. We've talked about trimming that the last couple of weeks, but also selling a covered call probably makes some sense against the remaining portion of your position. There's virtually no buy right opportunities. I looked. There's nothing that you can really buy right now and then immediately sell a covered call. There's just nothing. Everything's either cheap or expensive. There's almost nothing in the middle. So I take a look at AT&T and Barrick Gold. They're cheap. Sell a cash secured put. If they were, if AT&T was 33, 34, 35, I'd say maybe go ahead and sell a covered call, right? You could even do both. You could sell a cash secured put and a covered call, but we don't have really anything in the middle of their expected ranges, right? Where we think they're going versus how low they could go as well. So I've looked for buy right opportunities, and a buy right opportunity where you buy the stock is usually a stock that is coming off of oversold, and now it's got one of those RSIs of 50 or 60 or 45 maybe, but it's rising in price, and you sell the covered call because you're like, hey, I have already made some money, let's lock a little bit of it in. But there's just like nothing out there. MP Materials right here. We like, I'm looking to buy that on a pullback. Sun Run, through the roof. Sun Power. I just think you should be trimming the stock with all. Look where it is. So pull that up. That comes up to there. That comes up to there. One of these days, what the heck? How did this happen? There you go. All right. So as the price has gone higher, I've just pulled the blue line up. This is 22-ish, 23-ish. I think is pretty likely. Somewhere around 20 to the middle teens. Coincides with the current fib ratios. And you can see some jitterbugging there, some jitterbugging here. So those areas where the price bounces around, those are decision zones, and you should respect those. If you're going to write a covered call right now with this, you take a look at the RSI, and that's a pretty clear signal that this one's overbought. So I would trim part of your position, but then if you wanted to sell the February, or I would take a look at the March. If you're intent on holding on to this one, but you want to take some profits, I would probably take a look at the March covered calls. So the March 40, getting $5 for. So let's suppose that you bought 2% of your portfolio for SunPower, 3% of your portfolio for SunPower at or around 10, $8, $7, $12, whatever. You're sitting on a triple right now. I think you probably sell yourself all the way down to a 4% position or even a 2% position, and then write covered calls on part of what is left. If you sell the March 40, you get $5, which is a 16% return for holding this for about 2 months. If it goes over 40, you sell some of your stock. If it stays below 40 because there's some sort of a correction, you still pocket 16%. But if it rises past 40, from 37 to 40, right, that's about another 8% on top of that 16% premium. So about 8% more in appreciation plus 16%. Would it break your heart to make 24% in 2 months? And I really want people to wrap their head around the fact that the whole chasing mentality, I think, is affecting a lot of people. And when this turns around, people are going to get caught. So keep employing defensive measures like you would in any other market. Understand that with so many charts looking like this, we're not in reality land anymore. UBS just put out a note today and said, well, we understand that the market doesn't really care about fundamentals right now, but eventually it will. And that's where I'm at. The market hasn't cared about fundamentals for a very long time. There was a hot minute in March where it cared. Even that was just panic. In the very long term, fundamentals matter. So we want to use the opportunities of corrections to buy great fundamental stories. And while everybody likes Zoom and everything else that's out there now, that's gone up 4, 5, 6, 7, 800% since April, the reality is that the revenues don't justify those prices. But eventually the revenues and the prices will pass through each other again. And on the way down, we overshoot to the downside probably. So I would argue that the prices that we stopped falling at in March were right around fair value based on a full cycle. And just imagine that as prices go up and down, it never really stops at equilibrium. Prices pass through the fundamental equilibrium all the time. Shoot too high up on optimism, fall too far down on fear. Right now, we're just in delusional optimism. Yesterday on the Stocks of the Week show, I popped up a chart that showed the ratio of the S&P 500 and then the total assets of the Fed divided by the S&P 500. And you can see that where alligator jaws start to open up, you get sharp contractions. Well, we're starting to get alligator jaws again. If the Fed pulls back on liquidity a little bit, you're going to see the S&P 500 fall off the cliff. And we know that they're going to do it. Probably not this year, but they've hinted at talking about it. Isn't that weird? They're not talking about it. They're hinting at talking about it. So they're giving you a heads up to the heads up. The market's forward looking. How far? Hard to know. But one of the things that I warned about going way back to May is that probably all this optimism about eradicating coronavirus was going to be met with a lot more hiccups than I think people are expecting. So that's why in most cases, I'd more be a trimmer of stock than selling covered calls, except on the things that you really think are going to rally long term. And you're willing to play yourself through the volatility. Like you said, with SunPower, when you have a chart that looks like this, absolutely trim some of your position, at least take your profits off the table, right? So if your 4% position has grown to 6, pull it back to 4. And then decide with that remaining 4%, do I write covered calls against half or 2/3 of that? Just telling you that this is the mid and large cap stocks. You know, when you get 344 potential covered calls against a universe of 400 or 500 stocks, and granted, some of these have several covered calls, what it's telling you is that there's just way too many stocks out there that are overvalued. You can just pick one. Let's take a look at Abbott. Widely held. Love the company. They're in my backyard. But look at that chart. Does that make sense? In the context of their long history, really look what they've done since tax cuts, then the Fed. So what do we know about the Biden administration? Probably not in these first bills that they put through Congress, but when they do reconciliation, I believe that'll be September, that's when the tax increases are going to come. And it's not going to impact really anybody making under $400,000, but if you're making $400,000 or more, capital gains rates are probably going to equal the income tax rate. That's what they've said. That's what is in the platform, and he hinted at it again recently. $400,000 is going to be the demarcation zone for the small business tax breaks, for capital gains being at a lower rate, and they're going to get rid of a bunch of loopholes. And I don't know that they'll actually raise corporate income taxes, but there's going to be a lot of horse trading around that. And I think a ton of loopholes that allow companies like Google and Apple and everybody else that's swimming in cash to not actually have to pay taxes on that revenue. Right? They claim these big EPS, but they're not paying taxes, right? That largely is going to go away, and that's going to impact earnings. So between the coronavirus hiccups, right, because now we have two mutations that are pretty pervasive, which means that the vaccines will have to be rejiggered because it doesn't look like we have lifelong immunity. People are getting it twice. So I would just warn you that this market is set up to be very volatile eventually. I thought it was going to happen already. Maybe it'll be spring, maybe it'll be fall, who knows? But really think through your risk. And if you have stocks that have a chart that look like that over the last few years, or I tell you, we should always look at 2018 because of the sell-offs. 61 to 112. You know, that looks like a triple top to me in Abbott. Will it break out? I don't know. But if you have Abbott and you sold the $130 March covered call, you get almost nothing. You get almost nothing on all of these. See, implied volatility got to be pretty low. Huh? Look at those really low implied volatilities. So let's look at some of the higher volatilities. Plug Power, somebody asked me about recently. Let's take a look at that chart. What do you think that one looks like? So the deals they just got, is it really going to make the company that much more profitable? Well, then they're not profitable. Oh, okay. Eventually, fundamentals matter. Usually triggered by sentiment. Overshoot to the downside, overshoot to the upside. Palantir, again, not a very transparent company, hard to invest in. You're guessing on a lot of what their future is. Go right down the list. Just a ton of stocks in here. Here's an interesting one. This was a SPAC, and now it's this is the company that just launched the rocket from an airplane, right? So it's up 24% since that flight. SPCE. I will tell you, this is a stock that I'm watching. This will be in our SPAC column eventually. And I'm a little behind right now because I've had to deal with my website and everybody's saying I can't log in. I know that. That's why I'm working on it. And I'm 4 or 5 articles behind right now. Hopefully that changes tomorrow. So Virgin Galactic is still off of its initial hype peak. This is one that falls into this low 20s range. Going to be very interesting. Very interesting. Pretty strong support here, right? Red line is telling us where the basic confluence of buying pressure is. 17-ish. Tough to not want to buy it at 17-ish if it gets there. All right, any questions about any of the stocks you own or that you want to own? You know, sometimes the best thing to do is nothing. I know the people hate that. Somebody keeps asking me for actionable ideas. I know that's a term that the financial industry uses. Got to give people actionable ideas. Sometimes the best action is to go fishing, or right now, snowshoeing or something. Should be trimming a lot of these straight up stocks, charts, just trying to figure out when things turn negative, will the fundamentals of these companies reflect strength or will they get blown up? And if the fundamentals don't normally matter except in a very long, smoothed out time frame, how do you use that volatility to get in, right? When sentiment overshoots the negative side below the fundamental threshold, and how to use sentiment to get out when it drives prices above the fundamental threshold. Right now, the market is telling you trim, do it incrementally, little last week, little week before, little this week, little next week, sell some sell some covered calls against most positions, build positions in the stocks that haven't rallied yet, but look like they're coiled and have a catalyst and could. Liberty, right? Liberty Sirius, Ford. Even though Ford is overbought, gotta remember it started at $4. Right? Law of small numbers. Don't let that screw you up. Invesco. Invesco $23 or $24. Somebody asked about Invesco. It's largely, right? They have an activist investor that basically agreed with me about the company. $23 covered call for March gets you 40 cents. That's right around where you'd probably want to do some serious trimming. So I think the March 23 on Invesco makes a lot of sense. I did not look at the dividend date, so adjust for that. Do you know when Invesco's dividends are? If you own it, you should know this. 11/10, so 2/10. All right, so you get the dividend if you write the March. So I like that. I like selling the $23 March covered call on Invesco. It's overbought, but you still want that big fat dividend. So you shoot the dividend, you shoot the covered call out past the ex-dividend date. Stock comes back a little bit, it doesn't get called away. Actually, just as long as it doesn't go up much more. I like that 23 because that level there, that 2618, right? That's where it would come back if it has a false breakout. Because the breakout price is right about here, 2209. So if it goes above 2209, then comes back, does some jitterbugging before it goes back up higher. And on a correction, financial stocks get beat up, right? Money managers get beat up. So I haven't jumped into BlackRock just yet. I'm anticipating that these stocks come back to us. And I don't think this one comes back down to 12. We're right here, the 18 range, that's a 0.5 and a 618. So yeah, go ahead and sell the $23 March on Invesco. The next dividend date on this is February 10th, give or take. All right, no other questions? Well, then we will call it a day. I will try to get fundamental trends up and running in the next day or two. I've got the developer working on it right now. It's just a matter of getting the two pieces of software to talk to each other, and that's what we're doing. And it looks like there's one piece of custom code that has to be stuck in there. So he's working on it because that, again, is above my pay grade. In any case, there's not a lot to do out there, folks. Everybody's jonesing. The FOMO, I can feel the FOMO off of some of you. Got to get over it. If you're not a superstar trader that really is deep in the technicals, it's not what you should be doing. You shouldn't be chasing. You should be looking to trim into strength gradually over time. Everybody wants to do one big trade. Hey, one big trade. What should we do everything today? No, it's incrementals. Scale in, scale out. Said it a zillion times. And I really need you to embrace that and stop fighting it for those of you that are, because it's just going to hurt you because you try to be too perfect. You can't ever be perfect. When I learned how to bowl, my dad said, give yourself some margin for error as to which board you throw your hook over. Because he was shocked that I threw a hook when we went bowling one day. I don't remember how old we were, but I threw a hook. I was like 5th or 6th grade. He's like, where'd you learn how to do that? I watch Omletto Monticelli and Voss and all these other guys on the bowling show on Saturday afternoons that they used to have on 20, 30 years ago, 40 years ago, whatever it was. Give yourself some margin for error because markets do things based on news events, based on perceptions of liquidity, based on narratives that get manipulated, based on groups of traders that meet on Reddit and they all push something in one direction and they run away. It's all going on. All those pieces. All you can hope to do is make a reasonable estimate of what the fundamental value, the intrinsic value of a company is over the next few years, based on what they're currently earning and what you think they're going to earn in the next few years, based on catalysts and cost reductions and markets, right? You have to make your best estimate. That's your equilibrium price. And the market will push you above equilibrium price from time to time. You generally want to trim into that and sell covered calls. And sentiment will push you below the equilibrium price from time to time. And then you want to buy and sell cash secured puts. Right now, the market is way above equilibrium, way above. Not even a little above, it's way above. This is somewhere between the most expensive and third most expensive market in history. And third most is only if we adjust for interest rates. Nominally, this is the most expensive market in history. Adjusted for interest rates, I think you can make an argument for third most overvalued in history. So overbought leads to overvalued. And that's where we are right now. So be careful. Trim back to the size position that you want for the long term and even sell covered calls on part of that. All right. Have a good rest of the week. I'll see you on Friday. And hopefully everything in my tech world is back to normal by then. And we can just keep on investing. I think that there are some really interesting SPAC ideas out there. And I'm working on those right now. MP Materials is the one that is on our list to try to find a way to get into. I don't like this chart. But I think if MP Materials gets under 30 again, and probably it will, we'll take a look at selling cash secured puts. So let's let this come back to here again because it invariably will. And this is where we have to figure out how to sell cash secured puts. So we may be putting in a limit order and say, okay, I want a net cost of $22. So I'd probably sell the 25 when it's worth $3. So that's what we're looking for. All right, take care.